Well, I think one of the most heated debates today in the context of the European Union is fiscal union. Um, Now, this is something which is really not perfectly clear, partly because this is an agenda which has been under discussion very recently, and partly because there was no any consensus at this point, because different countries have different opinions. Remember, we have countries like Germany, which is pretty much advocating these austerity measures, while we have the French that is pretty much advocating a pro-growth exit strategy from the current financial crisis. So we will see how what's going to be the final outcome of this discussion. But clearly, this is something which is European-wide issue, and I think this is something which we are going to see in the future. Now, why the fiscal union discussion today? Well, I don't want to go back to the things that have been exhaustively explored by many economists and politicians, but there is something strange about the European Union, is that, especially about the European Monetary Union, is that we have a monetary union where monetary policy is outsourced to the European Central Bank, but we have fiscally decentralized and independent sovereign member states. Now, this implies a number of things. Remember, there are a lot of policy ramifications from this discussion, and one of these is, well, if we have monetary union but fiscally decentralized independent state, means that essentially different countries do not have any authority, any control over their monetary policy, and therefore they can't fix, they do not influence interest rates, they do not influence their exchange rates, but the exchange rates and the interest rates are all determined by the European Central Bank. Therefore, if they want to grow at faster speed, what they need to do is they have got to do something from the fiscal side, which is to maneuver their fiscal policy. Part of that is simply just by borrowing, and what we see today in Europe is there is a massive acceleration of public debt, which is against the violation of the Maastricht Treaty, or simply where public debt was supposed to be below 60% of GDP, and the budget balance was supposed to be below 3% of GDP. Now, the second thing which is strange about the European arrangement is that the European Monetary Union has never been what Professor Mandel calls its optimum currency area. What that optimum currency area seems to suggest is if you have economies that are heterogeneous in their structural parameters, and now create a monetary union, the likelihood that they'll suffer from asymmetric shocks is very high, which simply means there is going to be some kind of negative spillovers, or simply contagion effect, as the sickness of one member country affecting everybody else in the system, obviously with some that pretty much depends on the level of cooperation, interdependency, and so on and so forth. Second, from the monetary union, which is based on what people call it one size fits for all policy, means we have one interest rate for all member countries. That simply implies it may not necessarily reflect the development stage of countries under consideration. For example, countries cannot depreciate their currencies. Countries cannot maneuver with their interest rate, because that is something which is being outsourced back to the European Central Bank, and therefore they can't buy competitiveness advantage through monetary policy, and therefore they need to do something else. And one of this something else is, for example, to do something through the labor market, for example, by influencing nominal wages, so that nominal wages should catch up with labor productivity, which is not really often easy to do. Now, why fiscal union then? Obviously, from what we said, what I mentioned so far implies that it's very difficult to sustain a monetary union without having a fiscal union. Because what we have witnessed during the financial crisis is that a number of countries have violated the Maastricht criteria of this public debt to GDP, or 60%, because we know a lot of countries, exceedingly spending much larger than the 60% GDP. Now, what was the enforcement mechanism? Well, either to kick those countries out of the system, with all the political and economic ramifications and repercussions, or to bail them out, which was not in the initial package of the European arrangement. Now, because the bailout means nothing other than disciplined economies should subsidize undisciplined ones, whatever meaning we give to what undisciplined versus disciplined means. And that is equivalent to saying we penalize, in a way, success and reward failure, and that's clearly unsustainable. Both it's economically irrational and politically irrational as well, because richer economies are also under enormous political pressure from their domestic voters. So this is something which can be carried over to infinite period of time. So what must happen then? Well, we need to have a different arrangement. And how do we do that? Well, let us have a fiscal union. Now, there seems to be a kind of a smell of general consensus that, as we said, as mentioned earlier, that political union can hardly be sustained without having fiscal union. But the differences are widespread when it comes to how do we do it, how do we go about it. Now, first, why a fiscal union now? Well, the financial crisis, basically, the pending financial crisis has revealed that there are some structural weaknesses in the European Union, and part of the reason why countries are fiscally undisciplined also means maybe a reflection of weaker fiscal institutions in respective countries. The second thing is simply because the policies and the rules that are in place so far turn out to be ineffective, and therefore we need to have more powerful budgetary surveillance mechanism, which would make sure that the rules are actually met, and so that no country would end up affecting other countries and so on and so forth. Now, what kind of arrangement do we have? Well, what we know historically is conceptually two forms of fiscal union. One is so-called aid-based fiscal union, and that is simply just to offer financial injections to countries that are in trouble, and that is often in exchange for some kind of structural reform, which remember could well be very painful in some countries. And it's very difficult to sustain a very disciplined government which would be pro-reform and to be loved at the same time by voters. So this is very challenging. The second type is a loan-based, and the loan-based type of fiscal policy is where countries give loans to countries that are in trouble. But that's going to be both in exchange for structural reforms, but at the same time in exchange for potential repayment once the country gets back to recovery. So this is something which we know. Now, the economic literature also gives something else. There is something which is called transfer union, And the transfer union is where successful countries or regions are subsidizing less successful regions or countries or regions that are in trouble. But we have this fiscal union. And the fiscal union is a form of fiscal insurance to smooth out some kind of transitory shocks. And therefore, when one country is having sort of structural problem or cyclical problem, it may get injections from the system, but when the country recovers and some other country would have the same problem, so the injections would come. So it is a mutually rewarding process where countries are helping each other on temporary basis, not on permanent and systematic basis. Now, how this should be done, and this one of the discussions in Europe today is how this should be, what kind of system can we put in place so that the monetary union can sustain side by side with the fiscal union, so that we have a system which encourages everyone, but at the same time we have rules and policies that make sure that those that are violating rules and policies would get penalized in a way. Now, two options to do this. One is to create a kind of supra-European type of institution, which would be sort of watchdog over all national governments, which essentially means all national budgets should be approved by this Europe-wide institution, whatever we call that. And remember, that is before the budget is implemented, because it would be late, to go back and, check, well, you did a mistake last year. That's not going to be helpful. But this is just, to signal, given your potential to grow, given the parameter structures of your economy, well, this is a budget which is unsustainable, so it gets stopped. Therefore, there is going to be a rework, a readjustment before a budget gets launched. Now, the question is it going to have a kind of a federal type of, federalism type of fiscal union? Well, that is unlikely to happen without having a political union. So the likelihood that we may have a compromise in the context of having those rules and policies in place and giving to some kind of an Europe-wide institution an authority to ratify national budgets, but at the same time still keeping national parliaments and governments to be in charge of their fiscal policy is very high. And in that context, what we'd expect is a sort of a guarantee fund, sort of permanent guarantee types of fund, where budgets are being controlled by Europe-wide institution, but at the same time there is a permanent guarantee fund which is going to be used for bailout purposes if countries are violating those rules and policies for some kind of exogenous shocks. So there is, I think there is going to be a meeting in December. There is going to be a EU summit in December where they are going to elaborate. So a lot of things are not clear at this point, but this is what we would expect. So the probability that they would agree on some kind of guarantee fund is much higher than the probability that they would have a consensus to create a federal, type fiscal union. That is unlikely to happen in Europe. There is no political consensus on that, as far as I understand.